Right now, financial social media is full of crypto traders and tech investors taking victory laps. They are watching gold drop nearly 30% and lining up to dunk on the ultimate traditional asset. But laughing at an isolated price chart is a textbook trap. The biggest mistake retail investors make is measuring their wealth in raw dollars, instead of looking at an asset's true purchasing power compared to the rest of the market. This chart shows the S&P 500 priced directly against gold since 2022. Despite the massive artificial intelligence boom and all the hype surrounding tech stocks, the broader stock market index actually drops 44% below our gold baseline over that period. The numbers for the ultimate digital store of value look even worse. If we add Bitcoin to this exact same chart, we see it spending 7 consecutive months bleeding out, currently sitting about 60% lower than gold since December 2024. We are living through a multi-year rotation. Higher risk investments, from massive tech conglomerates to speculative altcoins like Ethereum, have been quietly losing their relative value to lower risk physical assets. So the traders cheering about gold's recent pullback are celebrating a false victory. They are holding depreciating assets and measuring them with a broken ruler. That raises an obvious question. If gold is structurally outperforming tech and crypto, why did it just experience a sudden, violent 30% crash? The answer is in the historical data from 1973 and 2008. In both of those periods, the economy was in a late business cycle environment, facing the exact same macroeconomic pressures we are navigating today. Notice the S&P 500 crossing below gold here, a warning signal before severe recessions. Leading up to those contractions, even during massive bull markets, gold took terrifying mid-cycle dives, dropping 27% in 1973 and 34% in 2008. These steep, double-digit drops are a completely normal feature of pre-recession environments. They are part of the process, not a sign that the asset has failed. Mechanically, these shallow drops serve a specific purpose. They act as a psychological trap, shaking out impatient retail investors while resetting market conditions that have become heavily overbought. From the 1974 correction, buying gold meant riding a steep upward curve to new all-time highs by 1978. But buying the stock market then meant a slow, flat grind, waiting until 1980 just to break even. Historically, gold consistently proves its ability to recover from severe economic contractions faster and with more upward momentum than traditional stock indexes. Enduring these terrifying mid-cycle shakeouts is simply the mandatory price of admission if you want to preserve your capital over the long term. Bringing the timeline back to the present day, we have to look for the specific economic domino triggering the next phase of this cycle. That domino is the labor market. Right now, standard metrics like initial jobless claims hover around 200,000, which paints a deceptively reassuring picture. But underneath those headline numbers is a much more sensitive indicator flashing a massive warning sign: the total non-farm payroll year-over-year percentage change. This gauge tracks that exact metric, and right now it is sitting at a razor-thin 0.0985. It is perfectly positioned to do exactly what it did in the 1970s and 2000s, preserve capital while everything else bleeds out. Your opportunity cost is too high to be caught in the wrong assets this late in the cycle. Stop trading on social media tribalism. Respect the data and align your portfolio before the fragile labor market breaks.